Hello and a warm welcome to Portfolio Watch. I'm Gugulethu Mfuphi, and on our show today, the topic that we're unpacking is taking a look at pockets of opportunity in emerging markets. Now, stocks and currencies from emerging markets are at their lowest in more than a year. Waning investor appetite for these markets has created attractive valuations, which will afford investors with a long-term view attractive results from quality companies with the right type of exposure. To help us unpack this and, of course, taking a look at the opportunities available, I'm joined in studio by Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Henry Biddlecombe, Equities Analyst at Anchor Capital. Gentlemen, great to have you both with us, and of course exciting topics that we'll talk about. I think when we think emerging markets, top of mind, we all know that we're not really fans of the global investment market right now, especially if Trump has anything to do with his tweets and the global operating environment. Clearly EMs aren't in favor. Henry?
Yes, I think it's hard to argue that the last 12 months haven't been a torrid period for emerging markets, and of course that includes South Africa. So I think you've got two major driving factors behind that, one longer term and in fact two shorter term. So one, you've got the global economy now having to digest higher interest rates, which has meant that the attractiveness of the carry trade in emerging markets has diminished somewhat, so you've had some outflows to deal with there. And then on top of that, you've had the trade war, which is risk negative, and obviously that's negative for emerging markets, and you've had a country-specific crisis in Turkey. But given the magnitude of Turkey in the global economy, I think it's the world's 18th largest economy, this is significant for all emerging markets, and it's pulled our market down with it.
Yeah, adds on to those pressures, and as we saw the ripple effects impacting on countries like South Africa, but Venezuela, Brazil are also some of those that also have some of their challenges here. What about China? Because I also know that stands out as another key opportunity still.
Yeah, so I think, when you talk about emerging markets, and as you mentioned, there's a lot of countries that are having their own individual problems, but people all think of contagion. So you've got Turkey, who now has issues around inflation, not wanting to raise interest rates, and as a result, everyone thinks that just falls over into other emerging markets. But actually, when you look at it and you actually unpack it, a lot of emerging markets themselves have their individual fundamental problems. We can look at home. South Africa is a clear case in point. You mentioned Venezuela, but looking at China, China's gone through this massive growth phase. It started in the late 70s. It took a hell of a long time, but the reforms started in the late 70s and only really came into effect in the late 90s, early 2000s, where you saw that big growth of what's around 10% at some point. But now it started to slow down. That obviously impacts China, but it impacts a lot of other emerging markets, because South Africa is a commodity-facing country, and we obviously export, along with, if you think of Latin America, we export a lot of commodities to China. So a slowdown in China would also have an impact on, not just China, but other emerging markets.
With that said, though, are there particular sectors that we need to look for when it comes to growth opportunities in emerging markets? We know that the growing demographic clearly speaks for numbers when it comes to FMCG companies or consumable companies. But we're also looking at the technology trend, right, which has shown quite an optimistic amount of growth. Where should we be identifying any sweet spots in EMs? Henry?
So I think to me it's less a sector-specific story, and it's probably more a market size story. So certainly where we're starting to see a lot of values in the small and mid-cap space on the South African Stock Exchange, and those tend to be stocks that catch a lot less flows than the bigger cap stocks do. So there, now you're seeing forward Ps of between 6 and 8, which for the longest time was a very rare thing to see. Now it's commonplace. So I think when and if flows do turn, investors will do very well out of that space. So I don't think it's a sector-specific opportunity, but rather it's an opportunity in the less well-known stocks on the South African exchange.
Andrew, would you agree?
Yes, I think if you think of emerging markets, you can think of it like small caps versus large caps in the South African case. So here you've got emerging markets. I think in emerging markets are slightly less efficient. So there's probably a few more opportunities, but with that obviously becomes a lot more risks. If you go to China or even India, if you think in India there's over 6,000 companies that are listed. So if you think about that, they're going to cover all sectors. So it's not necessarily sector specific, but there is a big tech sector and a service sector within India, likewise in China. But you actually need to be there on the ground. It's very, very difficult to sit at a desk in Sandton and try and understand what's happening in a small cap Chinese or Indian business or Latin American business. So I think you actually need to be on the ground, visiting the companies, understanding what's happening, within the business, as opposed to just reading a financial report and thinking you understand. So there are, a lot of nuances and risks that come with investing in some of these geographies.
Makes a lot of sense though, but for the novice investor, they also might think that a lot of these fundamentals are driven by economic growth. How much of the macros is actually connected to these opportunities, and of course investment stocks that we should actually look into when it comes to growth in emerging markets?
Yeah, so I mean, economic growth, as we know, over the long term, it drives corporate profits, which in turn drive returns. That's in the long term. Obviously, in the short term, there's a lot of sentiment that's priced in, and we see now as we have this risk of, Trump making some noise, if you want to think of it as noise, but that's caused emerging markets and Turkey to come under real pressure. And it's the same thing about thinking, of a business. You can have a great business that might not be a good investment because of price. Similarly, emerging markets, whilst I think the long-term growth prospects are definitely in place, if you think that Asia will be bigger than the US and Europe combined within about 7 years, that growth story is intact. India will become the third biggest country, I think, by the year 2030, I think it is.
Sure.
So those growth, stories remain intact, but the investment case is what you've got to be, I think, slightly more, circumspect about when investing, specifically in smaller cap companies.
Yeah, so clearly going through it with a fine tooth comb. With that said though, let's take a look at some of the equities and stocks that do present opportunities in emerging markets. We'll start off with the first one, which is Unilever, well known to many South Africans and of course across the globe with regard to the soap products that they made, household cleaning items. So really they cover the full spectrum when it comes to consumable goods for the average market in emerging markets. Do they still present a great investment opportunity here?
Yeah, so I think, thinking about Unilever, it's more of a defensive company, not as cyclical as some other businesses may be. But investing in emerging markets, as I said, going and looking at individual companies that are listed and operate within those geographies could be quite risky. Alternatively, you could go and invest in well-known global businesses that have large exposure to the emerging market consumer. And I think Unilever is exactly that. 58% of its sales come from emerging markets. So they're going to have that volume growth coming through from, call it the demographic dividend or the consumption dividend that's in place in these emerging markets. And if you just think from a brand point of view, you've probably touched one of their brands today already, whether it's in food, it's Lipton, the iced teas, household goods, Handy Andy, Omo, Domestos. These are all the products that we know in South Africa. And then obviously personal care, deodorants, soaps, Dove, etc. That's all your Unilever brands. So they touch a lot of points, within emerging markets, but also developed markets. It's a UK business listed in London, as well as in the US. So it's easy to get exposure, and it's obviously a large global conglomerate. So it's very liquid, easy to get exposure, and then as a result, you get that emerging markets exposure.
Makes sense. On Unilever, I hear you on the long-term plan, of course, it being a defensive stock. Richemont is also one of those that features on your list here, Andrew. Got me slightly confused because we often think about the luxury goods market here, right?
Well, yeah.
Do emerging market customers have some money to spare?
I think Richemont predominantly is a emerging market story. China in particular, I think 30% of their business comes from China. If you go to China or Hong Kong and you look at a Cartier store, you actually see queues around the block to get into these stores. Sure. I've witnessed this firsthand. So there's huge demand coming from China. It's obviously jewelry in particular, and then watches is another one. Richemont's also adopting the digital age. They bought that business Yoox Net-a-Porter recently that talks to the e-commerce side of business, and they're also moving, I suppose, down the chain from your high income to your middle and lower with their Balm watches, which is not your high-end watches, but more middle of the range type watch. So they are trying to tap into that middle income market, which is where the growth is when you think of China and India in particular. India doesn't really feature on Richemont's radar at the moment, but it's a huge opportunity for them.
Henry, is this one that you also keep in your portfolio? And of course, how do you manage sometimes the volatility that's attached to the luxury goods space, and of course some earning potential in GDP growth per capita for these consumers?
So I think Richemont earnings stream is a little less volatile than one would think. You know, over time, that business has become less dependent on watches, which in itself was an interesting story, because with the China crackdown on corruption, beg your pardon, that lopped off a huge amount of growth in that business. But it's become more of a jewelry business since then. And within that market, we've seen that there is a sort of structural shift towards branded jewelry rather than unbranded jewelry in your local jewelry store. And of course, with the stable of brands that sit within the Richemont Group, I think that's quite a positive tailwind for that group over time. So it's one I like.
One that you certainly like and clearly keeping in your portfolio. I also want to throw another one at you, which is Tsogo Sun. And we know in the local market, that's also taken quite a few changes, right, with regard to its portfolio, cleaning up a few assets here. And one would think that, of course, relies quite heavily on its hotels group, the casinos, and driving some kind of entertainment value through to consumers here too.
Yeah, so it's an odd one to choose in this environment, isn't it? But I think what's happened is over the last 3 years, having operated in such a low growth environment, it's forced management teams to look inward and say, well, listen, how can we unlock shareholder value in other ways? And this is quite an interesting story where, being a casino operator, they sit on very big, valuable properties. So what they're doing is they're actually moving around 23 billion rand in casino properties into a very efficient structure called a real estate investment trust, which the viewers would obviously be very familiar with. And cutting a long story short, if you value that earnings stream on a 10% yield, which we feel is more or less appropriate for that structure, you get value of around 15 Rand a share for the property assets. And given that the Tsogo share price is currently just 20 Rand, the implication is that you're valuing the casino business on a forward P of just 5, which even in this environment, I think is too punitive. So we think that the share's worth closer to 25 Rand, and obviously that represents a good 25% return over the next 12 months.
Yeah, so great investment potential there, but in comparison to some of its competitors in the market, Sun International, right, comes to mind?
So Sun is the most obvious competitor, and I think they're having a very tough time, although there are a lot of company-specific issues at play there. You've got massive leverage on the balance sheet. You've also had significant investment into new assets which are now underperforming in the form of Times Square in Pretoria. So on a relative basis, we far prefer Tsogo Sun.
Makes sense. Yeah. From your perspective here, Andrew, if we do take a look at that play, and of course specific to the South African environment, how have you seen things faring? And of course, is this one that you consider keeping in your portfolio?
Look, I think this would probably fall into more of a value, type investment philosophy. They've obviously been under pressure, what's happening locally within the economy, tourism numbers, etc. And then obviously, as Henry mentions, there's some company-specific issues, specifically at Sun International. But if you actually think about it, Tsogo Sun, you can get exposure to it through a company called Hoskin Consolidated Investments, which own 51% of Tsogo, and you can get that at a discount to what you buy in Tsogo directly on the market. Alongside that, you'll get exposure to other investments that HCI have as well, in logistics, for instance. So you'll get a more diversified exposure going through Hoskin Consolidated as opposed to going directly to Tsogo.
So multiple ways to actually skin this cat, but of course some opportunity and value that's certainly been identified. Well, you can join our conversation as well on social media and participate. Share your views on some of the stocks we're highlighting today with regard to identifying opportunities in emerging markets, and tweet us at CNBC Africa using the hashtag PortfolioWatch, or send your questions and suggestions to portfoliowatch@abn360.com. But when we come back from the break, we take a look at many more stocks for you to consider, the likes of British American Tobacco, Dischem, and even Standard Bank. We'll be back with more right after this. We're back and we're looking at opportunities in emerging markets. I'm still joined by my guests this evening here on Portfolio Watch, Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Henry Biddlecombe, Equities Analyst at Anchor Capital. Now, just before the ad break, we did touch on a few stocks, the likes of Unilever, Richemont, and of course Tsogo Sun, to give us some perspective with regard to the opportunities we see not only within the South African space, but emerging markets overall. I do want to touch on one that actually has a little bit more coverage when it comes to the continental sphere, and that's Standard Bank, well known and huge across the continent for its history and entrenched in the market for being one of the largest financial services providers. And having recently looked at their results, seemed like a mixed bag, but still keeping in line in trying to maintain growth and double-digit return on equity, especially from operations across the continent. How do you view Standard Bank? And of course, we know there's rising competition across the continent. Is this still viable?
So, I mean, obviously, if you think about banks in particular, they're highly geared, I suppose, to the economic cycle. And we've obviously gone through a fairly difficult period. We saw Standard Bank results along with a couple of other of the bank's results in recent weeks. And whilst they didn't shoot the lights out, I think they're doing a good enough job in the current environment. You know, the thing about investing in these banks is you want to be invested when the economy picks up. Yeah. Because they will obviously take, you know, right along with that. Standard Bank, if you think of it from an emerging markets point of view, within our banks in South Africa, they have by far the biggest exposure to Africa. So if you want emerging market exposure within banking, Standard Bank is the way to go. Obviously, Nedbank does have its EcoBank business, and FirstRand does have a bit of, you know, exposure through Africa. But I think Standard Bank has about 36% of its earnings come from Africa, and they're doing quite well. If you look at it from a valuation point of view, now Standard Bank is valued higher than I think what you'd look at it if you think of its direct competitors being Barclays or now rather ABSA and Nedbank, but its return on equity, as you mentioned, is definitely higher at about 17% at the moment, which is higher than your Nedbank and ABSA. And the outlook, I think, looks, whilst not, you know, it's not shoot the lights out stuff, I do expect them to continue to grow quite nicely. From a cost to income ratio, which is a very important number for a bank. If you think of Capitec, has a cost to income ratio of about 35%, whereas Standard Bank is 56%. You know, so they've got a lot of costs that they need to remove to get anywhere close. Not that they're going to get there. Capitec's a very different business, being a younger bank. But you know, if they can reduce their costs, that will materially help their earnings. And they're embracing RT as FirstRand did many years ago, and we saw what FirstRand's return on equity has done since then. As a result, they're priced a hell of a lot higher. But Standard Bank could, you know, in time, as they embrace and improve their RT systems, which they're doing, could get there.
You mentioned the IT, and that's naturally a theme that has been covered quite extensively here on the show, you know, the digitalization trend, the use of technology. And when it comes to the rest of the continent, we know that that's quite a competitive space here. Whilst we still like Standard Bank and consider it in our portfolio, are there any other gems that might be popping up when it comes to, you know, mobile money innovation and, you know, presenting a great opportunity when it comes to the long-term growth story here? Henry, not too sure if you're familiar with any. I know M-Pesa is always highlighted, but of course, that also has a link to a telecommunications firm.
Sure, it does. In the telecommunications space, I think that's a difficult sector to operate in at the moment. And you're seeing it in the results coming out of MTN, Vodacom, and Telkom. And in fact, those are shares that have derated over the last little while. So you're earning very low returns on capital. These are businesses that require huge capital expenditure investment over time. So it's not a space that we like, typically. And in terms of their exposure to the tech space, it's quite small. Relative to the core business, which is really providing voice and data services. I think there's one controversial stock in that sector at the moment, which I would flag, which could be interesting over the next 12 months, and that's Blue Label. And obviously that's a proxy for an investment in Cell C. They own 45% of that business. So at R7 a share, I think you're ascribing very little value to the interest in Cell C, if at all. And to the extent that you believe there's optionality in that business, I think that might be an interesting one, although it's not a stock for the faint of heart.
Not one for the faint-hearted, clearly. One opportunity that you've also listed here today is Cap Industrial, now also known for being under the Steinhoff umbrella. I'm already concerned.
So if you want to look at the cross-contamination between the two businesses, and for lack of a better term, there isn't really much beyond the history of the business. Over the last 12 months, they've gone to a lot of efforts to separate the shared corporate services element of the business, which is really the last connection that they had. The obvious problem there is the 26% shareholding that Steinhoff have in that business. So I think over time, Steinhoff will probably look to unload that asset. So that'll always be an overhang over the share until that's clear. But in the meantime, you've got a business that even in this environment is growing earnings at around 10%. It's currently trading at a pretty material discount to something like Bidvest, so it's on a forward P of around 11.5 versus Bidvest's 14. And actually, I think growth over the next 2 to 3 years in that business can pick up. So they've had a couple of company-specific issues in the chemicals business. They've had a plant upgrade that cost them more than they planned, and it took longer than planned, but that's now over. It's in the base, and I think on a forward 12, with expected earnings growth of 15% over the next 2 to 3 years, I think that's actually a nice growth story in SA at a reasonable price.
Nice, so significant one with regard to the growth there. Given that we are seeing pressure though still in manufacturing, in mining and any other sectors, doesn't that leave CAP slightly vulnerable to its exposure to some of these sectors there?
Logically, it does, but I think the fact that they've been able to grow earnings at 9% over the last 12 months is indicative of the defensive nature of that business.
Sure.
And again, you've got a management team who are looking very closely at replacing imports in the plastic space, so there's a natural path of growth for them independent of the macro factors. And you've also got an industrial division that's growing its operating margin every single year, so margin expansion can be a very significant driver of earnings growth in the absence of revenue growth.
Okay, so some growth there. You did touch on the competitive nature of CAP versus Bidvest, right? And we know recently Bidcorp also removed itself from Bidvest and listed independently. Also came out with a fairly solid set of numbers there. How does that compare? Because we know moving food around always works, right, in the emerging market space.
It certainly does. So, I mean, this has proved to be a very defensive business. I mean, in the context of emerging markets, about 2/3 roughly of profits come from emerging markets, but all over the world. So even though it's an EM-focused business, it's a very diversified business.
Yeah.
And this is, again, a business that's very focused on margin expansion, which again can drive very consistent earnings growth, even in the absence of a low, even in the context of a low growth environment. And we think that they can grow earnings at a rate of 10% ad infinitum almost. So it is expensive. It's on a 420 PE, but relative to global peers, it's not all that expensive. And I think it's a good quality currency hedge for a South African portfolio. And I think I rate the management team highly.
Management team has also been there since it was under the Bidvest umbrella.
Yes.
But I want to pick your brain on this one, Andrew. Does it feature on your list of favorites maybe to consider?
Yes, absolutely. So at Private Client Securities, we've held Bidcorp. So we initially held Bidvest and then they broke up into the two businesses. We now at the moment hold both Bidvest and Bidcorp. So we like both of those businesses. If you just think of Bidvest, we talk about CAP, you know, it's a very similar business, fairly cyclical. When the economy picks up, it will do well. But you can't wait for that turnaround, you know. So whilst you know the market's depressed at the moment, this is the time to be investing, you know. So you invested or exposed when that market does turn around. Bidcorp is also, you know, very high quality business. I'd agree with Henry's observation. You know, you're getting hard currency earnings. It's got emerging market exposure. You know, you are paying up for it, but it's, you know, you pay up for quality. So it is one that we like.
Another one that has often been featured on the show is British American Tobacco, whether it's you know, from a corporate governance point of view or looking at the environmental effects. But of course, as we know, it's been a firm favorite of many South Africans when it comes to their portfolio. Are there still growth opportunities here? Are we still looking at it as being quite a favorable stock? Let's certainly hope it doesn't turn into an Anglo, right, in the long term. Henry?
Yeah, so I don't think it will. And you know, you have to point out that over the last 2 to 3 years, these utilities and consumer staple stocks have fallen out of favor because you've got these growth stocks all over the world that are growing at a tremendous clip.
Yeah.
You know, you've got the Facebooks and the Googles and the Amazons of this world. They're growing earnings at 20 to 30% per annum. So people aren't excited about a tobacco company that's paying a 5% yield every year anymore. But that means that there's been a huge rotation out of them. And what's happened? The valuations have come right off. So I mean, early on in this year, we were buying British American Tobacco on a forward PE of 12, which is unheard of, really. And I think that you're going to start to see a rotation back into these stocks as valuations become more and more extreme. So I think that's a nice place to sit. Yeah.
Andrew, would you agree? I know that we've discussed it previously on the show, but still some strong investment fundamentals here?
Yes, absolutely. So, you know, for British American Tobacco, I think the time to get in was probably a month or two ago when it traded at about 600 Rand a share.
Sure.
Now it's, you know, back up to well over 700. So they did come under a huge amount of pressure early on in the year. You know, the issues around, you know, smoking and the sustainability of it, that's been around for years. And, you know, it's not going to go anywhere, but these businesses continue to grow as we've seen. If you think of it from their pricing point of view, we've discussed this before, their ability to increase their prices, you know, given the huge amount of tax that they have to pay, you know, these companies can increase their prices without the consumer feeling it that much, which really plays to them. Alongside this, great dividend payers, you know, fairly defensive businesses when you think where we are in the cycle. I think it makes sense to have exposure to these more defensive companies like your consumer staples or your tobacco companies.
Well, consumer staples, whether it's consumers, drinking in good times or bad times, we obviously know that we need to eat. Maybe taking a look at, of course, some tourism and, of course, some activities. But what about healthcare? And this is certainly where Dischem comes in, recently listed on the JSE. And, of course, there's been interesting conversations with regard to the investment potential here, given just how tight the shareholding of this actual company is here. Henry, but you see some opportunity here, even though they've been rather slow with the rollout of a lot of their stores from a South African point of view, which makes them slightly smaller than the competitors, being Clicks, right, with regard to exposure in stores.
So that's a good observation.
Yeah.
So in 2 years from now, they're planning on having 200 stores, up from about 140 currently. But you need to put that in context of Clicks' store base of over 500 stores. So the important point to make is this company has a huge natural growth runway, doesn't it? Mm-hmm. So again, even in the context of a weak macroeconomy in South Africa, this is a company that can grow its earnings simply by expanding its store footprint, and there's certainly scope for it to do so. So to cut a long story short, we think that by growing to 200 stores and beyond, this is a company that can actually sustain earnings growth in the region of 20 to 25% over the next couple of years. It is looking expensive. It was trading on a forward 25 PE last month. That's now re-rated to a forward 30 now. So it's trading more or less at parity with Clicks. But again, in this sort of environment, investors are willing to pay up for growth, aren't they? And on a forward PE of 30, if you're growing earnings at 25%, that multiple unwinds quite quickly as well. So it's one we like, even at this level.
Clicks or Dischem, Andrew?
Can I go with neither?
I was going to say it's going to be based on your loyalty card that you have, right? But
I think that would go to my wife. I think it's Clicks there. I'm skeptical on the growth that has been priced into these businesses. They're great businesses, and there's no doubt about that. But rolling out these stores, you've also got to ask yourself the question around cannibalization. Do they start? I think there's one opening at Dischem, if it hasn't already opened, at Sandton City, but then there's one across the road at Benmore. So now you've got two Dischems literally across the road. Is the one going to take footfall away from the other one?
Yeah.
So that's the question, but I'm more skeptical around paying up 30 times forward PE in this environment for a retailer.
Well, we'll leave it on that note for today, as some critical points, no doubt. It's about timing, not time in the market, rather, not timing the market. But a big thank you to both my guests for joining us, Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Henry Biddlecombe, Equities Analyst at Anchor Capital. Now, do be sure to tune in again next week at the same time, where we'll bring you more insight into some great conversations regarding investment potential from across the globe. Until then, though, join the conversation on social media at CNBC Africa, #PortfolioWatch, or send us your questions and suggestions to portfoliowatch@abn360.com. We'll see you then. Have a great evening further.